Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Labcorp traces its origins to 1978 as Roche Biomedical Laboratories, becoming Laboratory Corporation of America through a 1995 merger. Today, it is the second largest clinical lab network in America.
The diagnostics segment processes over 165 million tests annually through a nationwide network of patient service centers, hospital labs, and physician office collections across all 50 states.
The national network creates structural advantages. Labcorp's specimen volume enables it to run specialty tests that smaller labs cannot afford to set up, and dense collection infrastructure reduces turnaround times.
Oncology testing is where Labcorp has invested most deeply. Molecular diagnostics and genetic testing for cancer support precision medicine programs at major treatment centers, a high-value, high-complexity category.
The 2015 Covance acquisition added a major contract research organization, creating the drug development segment that now contributes roughly 38% of total revenue.
CEO Adam Schechter joined from Merck in 2019, bringing pharma commercial experience. He has focused on integrating the diagnostics and drug development platforms and expanding international CRO capabilities.
The drug development segment, now branded Labcorp Drug Development, provides clinical trial management, bioanalytical testing, and central laboratory services to pharmaceutical and biotech companies globally.
CRO revenue growth is targeted at roughly 8% annually, driven by pharma outsourcing trends. Drug makers increasingly prefer external CROs to building fixed internal trial infrastructure for each program.
Adjusted operating margin sits around 15% across the combined business. Diagnostics margins are stable. Drug development margins are more variable depending on clinical trial mix and timing.
CLIA and CAP accreditation create meaningful barriers to entry. Labs must invest in quality systems, proficiency testing, and oversight infrastructure that takes years to establish and is tightly regulated.
Competitively, Labcorp and Quest Diagnostics together dominate the U.S. independent clinical lab market. Their combined scale gives them pricing power with health plans and test menu breadth hospitals struggle to match.
CLIA and CAP accreditation create meaningful barriers to entry. Labs must invest in quality systems, proficiency testing, and oversight infrastructure that takes years to establish and is tightly monitored by regulators.
The risk is reimbursement pressure. Government and commercial health plan rates for routine testing face pricing pressure, and any reduction in Medicare lab fee schedules would directly impact margins.
For healthcare investors, Labcorp is the essential infrastructure of diagnosis, a business touching virtually every patient encounter in the U.S. system, with the scale to defend that position.
For healthcare investors, Labcorp is the essential infrastructure of diagnosis, a business touching virtually every patient encounter in the U.S. system, with scale to defend that position.
The combination of national lab density, oncology specialization, and growing CRO capabilities gives Labcorp an increasingly differentiated profile as precision medicine adoption continues to accelerate broadly.
That's the company chapter for Labcorp. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Labcorp just beat Q1 estimates and reminded the market why it's one of the most durable businesses in all of American healthcare. 600 million tests per year, aging demographics driving consistent volume growth, and a pure-play diagnostics model after spinning off its pharma services unit into Fortree. Is this stock genuinely undervalued at 12 times earnings? Let's find out.
Labcorp is one of the world's largest clinical laboratory networks, headquartered in Burlington, North Carolina, with 60,900 employees. It processes over 600 million tests annually across its network of labs, serving physicians, hospitals, employers, and government health programs across the United States and in select international markets.
In 2023, Labcorp spun off its contract research organization business into Fortree Holdings, transforming into a pure-play diagnostics company. That strategic focus has sharpened the investment thesis considerably. TTM revenue is nearly $14 billion, growing at 7.2% year over year, with a PE of 12.6 times that. Looks genuinely cheap for a compounder with this quality of earnings.
Q1 2026 revenue came in at $3.51 billion, in line with consensus estimates. EPS was $4.25 versus a $4.09 estimate, a 3.9% beat. That outperformance came from a combination of volume growth, better than expected test mix, and continued operational efficiency improvements across the lab network.
On a trailing 12-month basis, Labcorp generated $13.95 billion in revenue, with net income of $876 million. Those are high-quality, recurring earnings tied to healthcare utilization rather than economic cycles. That is precisely the profile investors want from a defensive, long-term healthcare holding.
The balance sheet reflects the company's post-spin positioning. Cash is $532 million, debt is $7.2 billion, and equity is $8.6 billion, with total assets of $18.4 billion. Leverage is moderate and manageable given the stable, predictable cash generation that characterizes the diagnostics business model.
Cash flow is a genuine strength here. Operating cash flow on a TTM basis was $1.64 billion. After capital expenditures of $434 million, free cash flow was $1.2 billion. That represents a 12.2% FCF yield on revenues, exceptional for a company of Labcorp's scale operating in a regulated healthcare environment.
The stock trades at $2.15 with a market cap of $21.1 billion. The PE ratio of 12.6 times is notably low for a healthcare business with Labcorp's quality of earnings and dominant market position. The company pays a dividend yielding 1.05%, and has been aggressively repurchasing shares at this discounted multiple.
Labcorp has been deploying that free cash flow into buybacks at what management believes is a meaningfully discounted valuation. That capital return story, combined with volume-driven revenue growth from demographics, is the core bull thesis. Investors get paid to wait while the business quietly compounds in the background.
Street consensus leans bullish on Labcorp. Most analysts rate it buy or outperform, with price targets clustering in the $230 to $260 range. The thesis is consistent. Demographic-driven volume growth, genetic testing expansion, and a cheap multiple create a compelling setup for the next 2 to 3 years.
The most frequently cited bull catalyst is aging demographics. As the U.S. population skews older, healthcare utilization rises, and lab testing sits at the center of that trend. More chronic disease management, more preventive screening, and more genetic testing all drive Labcorp's volume without requiring the company to win new market share.
Genetic testing and precision medicine are the growth vectors Wall Street is most excited about. Labcorp's capabilities in genomic oncology, hereditary disease testing, and pharmacogenomics position it well as those testing categories expand. These tests carry higher reimbursement rates than routine panels, which is a positive mix shift.
Bears on the street point to managed care reimbursement pressure as the key risk. United Health Group and other large payers have been pushing for lower lab test reimbursement rates. Medicare rate cuts are a recurring legislative threat. If those rates compress faster than volume grows, margins could erode despite the volume tailwind.
Competition from Quest Diagnostics is the other street concern. Quest has nearly identical capabilities across most testing categories, and pricing competition between the two can intensify, particularly for large hospital and employer contracts. Labcorp's differentiation lies in its specialty and esoteric testing portfolio. That's where margins are best protected.
The bull case is grounded in demographic inevitability. 65-plus Americans use 5 times the lab services of younger cohorts. With 73 million baby boomers aging through peak healthcare utilization years, Labcorp's addressable volume is growing without the company needing to do anything except show up.
Genetic and precision medicine testing is still in early innings. Hereditary cancer panels, pharmacogenomics, and liquid biopsies are going mainstream. Labcorp is positioned to capture that shift. These specialty tests command better reimbursement, have higher barriers to entry, and are growing faster than the core routine testing business.
Capital returns are underappreciated. Labcorp is buying back stock at 12 times earnings, a historically low multiple for a company of this quality. If the market re-rates it toward 15 to 16 times, more in line with peers, the stock could move 30 to 40% before the business needs to grow a single dollar.
Reimbursement risk is real and persistent. Every federal budget cycle brings renewed pressure to cut Medicare clinical laboratory fees. The Protecting Access to Medicare Act established a benchmark-based cut mechanism that has repeatedly reduced lab reimbursement. That's a structural headwind that volume growth has to outrun every year.
Managed care contracting is the other pressure point. As UHC, Cigna, and other large payers consolidate their own market power, they push harder on lab reimbursement. Labcorp can lose a major payer contract, which hurts volumes and revenue simultaneously. The Quest competition makes it harder to hold the line on pricing.
Execution risk from the Fortrea spin is worth noting. Separating a large contract research business is operationally complex, and some shared infrastructure and talent had to be divided. If any residual entanglement creates unexpected costs or service disruptions, it could weigh on Labcorp's margins during the transition period.
The debt load of $7.2 billion, while manageable at current cash flow levels, limits flexibility. In a scenario where reimbursement cuts compound and volume growth slows, the leverage ratio could become a concern. Labcorp doesn't have the balance sheet flexibility of a cash-rich competitor to absorb a prolonged revenue slowdown.
Quest Diagnostics is the direct apples-to-apples peer. Quest trades at a similar valuation, generates comparable cash flows, and competes in the same lab testing markets. The two companies together process the vast majority of commercial lab testing in the United States, effectively an oligopoly in routine diagnostics.
Sonic Healthcare is the international comparison. It's an Australian diagnostics company with significant operations in Europe and Australia that has taken a different geographic expansion path than Labcorp. Sonic trades at a premium on an absolute basis but reflects the higher growth available outside the U.S. reimbursement environment.
Charles River Laboratories is sometimes grouped with Labcorp, given the historical pharma services connection through Fortrea. But Charles River is really a drug discovery and research services company, a very different business model. It's more useful as a benchmark for Fortrea than for Labcorp's current pure diagnostics profile.
Against all peers, Labcorp's 12.6 times PE stands out as the cheapest. Quest trades at similar multiples, suggesting the market is pricing the whole sector conservatively. When healthcare spending grows and reimbursement fears recede, both names tend to re-rate simultaneously. Labcorp's buyback makes that re-rating more powerful per remaining share.
Options activity on Labcorp shows relatively modest implied volatility compared to the broader healthcare sector. This reflects the stability of the business model. Lab testing volumes don't spike and crash the way biotech clinical trial results do. The market is pricing in steady, modest moves around earnings rather than binary events.
Insider activity has been a positive signal. Management team members have made open market purchases in the $200 to $220 price range over the past 12 months. CEO Adam Schechter has been consistent in communicating confidence in the buyback program, and when executives buy alongside the company's own repurchases, that's a meaningful alignment signal.
Institutional ownership is high and stable, with major healthcare-focused funds maintaining or adding positions. The stock's low multiple relative to the S&P 500 has attracted value-oriented investors who traditionally avoid healthcare due to complexity. Labcorp's predictable recurring revenue model is easier to underwrite than drug development risk.
The key catalyst to watch is any legislative development around Medicare lab reimbursement rates. A surprise cut announcement could send the stock down sharply in a single session. Conversely, if Labcorp raises guidance in Q2 and demonstrates volume acceleration from genetic testing, the multiple expansion trade becomes very compelling at current prices.
Labcorp is a high-quality diagnostics compounder, trading at a price that doesn't reflect its cash generation or demographic tailwinds. The Q1 beat is incremental positive evidence. Reimbursement risk is real, but manageable for a company with this market position.
At 12.6 times earnings with $1.2 billion in free cash flow, Labcorp looks undervalued. Demographics are your tailwind, buybacks are your floor, and genetic testing expansion is your upside. This is the kind of boring compounder that quietly outperforms over 5+ years.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.